Welcome back to Precision Trader University. In today's video, I want to once again show you how to use the most powerful trading tool in the stock market to go pick up, go find free money in the market. I mean, when you talk about free money, this is as close as you can get to being able to having a tool, having a strategy that is going to day after day be able to deliver you free money in the market. All right. Now, again, you have to know how to go pick up that free money, where it's being handed out at, and BOOKMAP shows you how to do that. So I'm going to show you my three. I always like to show my three strategies in the videos to help you take advantage how to take money from the market. So with that said, we're going to focus in on the SML today, the short at major liquidity. That's going to be the particular strategy we're going to take advantage of here on PDD. We took advantage of this stock. Again, I always like to, for the most part, show you stuff that we played live during the trading day. Again, I'm not big on the hypothetical stuff. A lot of people can find stuff after the fact, all that kind of stuff. Again, I want to show stuff that, hey, we caught this, found this, easily scanned for this in live time, took advantage of it, all that good stuff. So anyway, with that said, PDD was the stock that we found this morning. Beautiful example here of the SML. They started the day at about $76. And a good reminder, always want to take a few seconds, go look at the pre-market, see what the pre-market looked like. In this case, PDD, you had beautiful liquidity. Again, what are we qualifying as major liquidity for this strategy? Something we can see on the $5 increments. If we can see it on the $5 increments, it qualifies as major liquidity. And that's what ultimately our strategies are based around. Identifying major liquidity and playing around those levels and taking the free money that comes around them. So again, you just have to understand how to take advantage of it when it gets around those levels, or if you're playing to that level. So with that said, if you're not familiar with BOOKMAP, it's very simple here. It's just the buyers and sellers, sitting in here on a visual heat map instead of a dome, something like that. You're just seeing numbers. Now you get to visually see it. You can see where these buyers are sitting. And again, that's signified by these orange and red heat map bands. So again, you see orange and red on the $5 increment. Yep, that's, there's major buying and selling there. And when you know where the major buying and selling is, I teach ones how to use some very powerful strategies to take advantage of that. So with PDD, we know the bias for this stock today is to the upside. They want to get it to this monster liquidity up here. Liquidity acts as a magnet, gravitational pull. They want to suck it into 80. There's really nothing down below. The only way it's going down here is if the whole market falls through the floor. If the market don't fall through the floor, it's getting to this 80. So yeah, it's just how it is. Anyway, so with that said, we start the morning here. Beautiful start to the day. Let me make sure I got the 1 minute candles. Sure, got that. Okay, good deal. All right, so what do? They come down. They find support here in the 76s. They start pushing up. Where are they pushing up? 79. 79 is our first level of major liquidity. All right, so that one you could still see on the $5 increments. So we know that there's a good chance they're going to do some front running. All right. So normally what our preferred way to do is when we see front running liquidity like this, that we can visibly still see, close to those $5 increments, we're more than happy to play at the front running liquidity. So again, what are we looking to do? So whenever they're pushing into this major liquidity, we know that there's going to be profit takers at major liquidity. Okay. It is 99% probabilities that you will find profit takers at major $5 increment liquidities to the upside. It just is. You can watch it, go back and look at it for yourself time and time again. We have, 700 to 800 trades that we've done over the past year or so showing this, these strategies time and time again. So again, it's not, oh, well, it happened sometime or you can only find it in the perfect situation. No, this stuff happens again and again, day after day. Okay. And again, it's the same thing again, because if you really want to get very, very confident with your trading, you need to have strategies that are simple and that repeat time and time again. There's not, 40 different, levels of complexity here. No, it's very simple. When the stocks push up into these orange and red bands, okay, it pulls back. Okay. And when it pulls back, that's when you make your money. So you're entering just in front and then you're making that pullback money. So with that said, we have front running liquidity here at 79. They push up to 79. pull it back into the 77s, beautiful pullback there. All right, now what do they do? Because again, whenever they front run a liquidity, a major liquidity, a $5 increment liquidity here at like 80 right here, I'd say 8 to 9 out of 10 times, what are they going to do? They're going to push right back up and get to that major $5 increment of major liquidity. All right, so what do? They push right back up, and now they absorb the front running liquidity. All right, it absorbs, it disappears. Now we know the front, the door is open for them to walk through and head on up to the major liquidity. Now, again, does that mean just because a major liquidity gets absorbed, does that mean they're automatically going to go to the next one? Absolutely not. That just means the door is open. Now they have the potential to be able to walk through it. All right, but at the same time, we know that 80's on the other side, the major liquidity, so we know that there's a very good chance they're going to walk through it. All right, so what do? Support, push up to 80. Now, this is where we enter. This is our SML, short at major liquidity. All right, so we're in at 80. All right, and what are we looking for? We're looking for them to suck back into at least the front running liquidity $1 dump. All right, which they do. They suck it back in there. Really nice. Now, I had some traders that got back in. All right, now, normally I don't recommend it, especially when you got nice liquidity up here on 81. But in this situation, what happened? They pull it back and then they bring liquidity right back in. Okay, that's the only situation that I'm like, okay, you can re-enter on the major liquidity. All right, is if they bring it right back in, that's showing that there's enough people looking to take profit again that you can justify getting back in there. If you don't see this and you see liquidity up here, it's a big no-no. We don't do that. Again, our initial test on the major liquidity is what we're looking for. The initial test is where the free money's at. That's where they're like, hey, here, take this money, okay? Here you go. So you just got to be there to pick it up. Anyway, so we see there, they dump back. Now, where would we looking to potentially take some runners? All right, so where could you have been like, okay, where are they looking to get back? Well, that's where we're going to use our algos. Okay, so our algos are computer trading levels. Institutions trade off these levels. Again, these are automatic levels that are put on your chart at the start of every day. We love to use these for take profit levels, okay, for scaling out on our positions. All right, so I'm going to pull up that for PDD. So our first level off of that that short at major liquidity at 80, we have one down here at $78.58. So we absolutely, want to hold some runner for that, because we know that there's a very, very good, or half a position. Again, we always like to break. I'll try to teach people. You want to try to be able to break your positions up into 4. Okay, that's going to give you quarters to be able to go in. So, for example, say a certain area, like I told once today, hey, I couldn't have blamed you if you wanted to get half the position at 80, and then for some reason, some extra volatility came in, they blasted up to 81. You finish out the rest of your position for the push through spot. So again, that was a way to take advantage of that as well. Now, with that said, when it comes to taking profit, again, holding some of that position back to this algo. Oh, I'm telling you, when you see a big algo gap into a major liquidity SML position, the vast majority of the time, they are going to suck back in to the algo below. Okay, I've seen it happen countless times. Okay, so anyway, so just keep that in mind. Very, very powerful, because a lot of people, like, they can get in, they're like, okay, I got in with you. Great, it works. Now, where do I take profit? Well, your dollar increments, your algos, like I said, that's what you're basing your scale out process on. Your dollar increments, and then also to your major algos below. And then if you want to hold a little bit of runner into the 5, for the dump all the way back in the $5 increment below in certain situations, especially if something's run really hard or it's a high flyer, more power to you. Now, again, something sub 100, yeah, for the most part, you're looking for $1 to $2 is usually around your sweet spot. So anyway, so keep that in mind. Going back over to PDD, and we see from there, bam, we dump down into that algo there, and pretty much we've been chopping around sideways on it the rest of the day. But anyway, so that was PDD. Took advantage of that one. Just want to give you another one real quick here for just demonstration purposes. Didn't find it in time. I was doing some scanning after the fact, just seeing what I could share. And anyway, so I did find this one real quick on the scanner. So beautiful example here. Another thing to keep into consideration, I want you to work hard on is with your trading plan is look at the average ATR for the day. Okay, so for Goldman Sachs, let's see here. Well, I'll tell you what, I'll just, instead of showing you, or instead of telling you, let me show you. Okay. ATR right here, Goldman Sachs. I got an ATR down here. Again, I don't use the 14, the average 14. I don't want that. You need to adjust that down to the 1. That way you can see specifically what each individual day is. All right. And then you can come back here and look at the whole year or the last 6 months to a year and see what, okay, where's this thing averaged at? Okay. So we know for Goldman Sachs, there's somewhere up here in this, $7 area is where they've been averaging for an ATR. So we know of that $7, about 80% of that, we know they can easily do that in one move. So that's, $5 to $6. They can easily get to going $5 to $6 in one direction. So take that over to Goldman Sachs here. And so again, we're looking for this thing when it gets to around, $4 to $5, that, hey, they're very well could, start running out of gas. And what is this? How does this work out perfectly? They push from 379 up to, and where's our next major liquidity at? Bam, 385, 386. So that's where you get over here on the $5 increments. That's it. You can see the orange and red there on the $5 increment. So bam, this is a good level. So Goldman Sachs is pushing. And where did they push it up to? 385. And then what did they do? Handing out free money. So it's really that simple. Again, you can go through and find these all over the place. Again, it's very simple. You go in, you find the $5 increments here, the major liquidity on those. Again, you're using that as a guide for where they want to push to. And then when they get there, where they're going to be handing out free money. So again, if you want to play this strategy ultra safe, you combine the push through strategy and the SML. So the SML spot is right at just under 385 because that's the major liquidity. And then 386 is the push through. The push through is a $1. Historically, the market is going, when it pushes through on a major liquidity, it's going to push through right around $1. And then what are they going to have to do? They got to come back and retest the major liquidity. So if you want to play it ultra safe, you take a half position. You started at the SML spot here at 385, and then you save the other half for 386, just in the event they get through, they hit 385 and bam, they give you that quick, because when that happens, it's a quick pop through. Okay. But at the same time, that doesn't happen, that only happens, 10 to 20% of the time. Okay. You can't rely on it. Now, when you get a really volatile market, you can see it more often, but historically you're not. Historically, the vast majority of the time, you're going to get right to this major liquidity and then they're going to pull off of it. Okay, so yeah, but at the same time, while the market's still volatile, you want to play a little safer. Enter at the SML spot, 385 in this case, half your position there, because again, your position's cut up in 4. So again, with our options, again, we love to play options on a lot of this because again, it allows us to play things for extremely cheap. Okay, because again, we're not going to be in these positions very long. Look, our profit comes quick. We don't have to hang out in these stocks for very long. So we're able to get in, get out. So we're able to take these, these very expensive stocks and use options to turn them into penny stock prices. So a lot of people want to play the penny stocks. Well, no, I'd prefer to use options. I'd prefer to use options and turn, and use that same and get my, the price, the entry price down really, really low, because again, why not? I mean, I'd much rather somebody use four option contracts. Because again, ideally we want to, have the position where you're in quarters. So, four contracts. So that way they're all, so we're going in half. So that'd be 2 contracts at 385, 2 contracts at 386, give you a full position. All right. So I'd much rather somebody get 4 contracts, say they're at a 25 delta. They're controlling 100 shares. That's going to be way cheaper than getting 100, astronomically cheaper than getting 100 shares of Goldman Sachs. Okay. So, because again, that's why a lot of people don't want to play the big cap stuff, the mids and the bigs. Oh, it's so expensive and I don't want to play options. Well, again, if you're not taking advantage of strategies like this, I don't recommend trying to play options intraday. Okay. It's not, or intra-week. It's extremely dangerous. But when you're in positions on average 2 to 20 minutes like we are, I mean, we don't have to wait long for our profit. We're in, bam, we get our profit and we're out of there. You just saw both examples on PDD and this Goldman Sachs. You're not hanging around in there, for a long period of time. So, with that said, yeah, it's definitely if you're interested in options, man, this is a extremely powerful strategy to take advantage of options. and then avoid all that, you know, the dangerous theta decay and all that kind of stuff. The only time we're really paying attention to the theta decay is on expiration day, especially the last hour or two of the day. Or the last 3 hours of the day. The first 2 hours, not really worried about it. But after the first couple hours of the day, that's when we start paying attention more. Okay, how far is my contract out the money? That type of thing. But with that said, you know, when you're getting quick moves like this, the options move just fine, just fine. So anyway, so hope that helps you there. If you have any questions, feel free to come over to the server. You know, live doing this stuff, trading this stuff live intraday. I'm sharing all this in live time, and yeah, be more than happy to help you out. So with that said, appreciate you watching the video and enjoy the rest of your day.